Dan says, could you discuss selling spreads using the PO tools criteria for getting in and out and setting up great searches? Okay, well, in my opinion, and I'm biased, the criteria is already set for you. The criteria that I use for bull put credit spreads is shown right there. The bull put credit spread weekly, this is the criteria that I've tested for bull put credit spreads and traded over several years. Okay, system's just running through its search here. There we go, much better. Okay. So Dan, the default criteria for the bull put weekly minus that change I need to implement in there, this is the starting point. When I'm trading bull put spreads and I open them Monday afternoon, I take directly from this list. Same on the bear call credit spread weekly positions. Okay. Now the debit spreads, it depends on how you want to trade it. I had a great discussion today, Dan, with Elizabeth on setting up a search for an at or out of the money bull call debit spread, which is a lower probability, but is more of a 2-to-1 risk-reward ratio. Instead of these, which have a high probability, 85, 87, 88, with still a strong return on the position, if it works out. However, I would never do an at or out of the money bull put credit spread because the short option is starting in the money. But you could do that as a bull call debit spread because it's out of the money as well. So you can adjust these criteria any way you want, but this is my preferred search for bull put credit spreads, the bull put weekly. I have to make that change to 9%. And then, of course, the bear call credit spreads, bear call credit spread weekly, and depending how you wanted to approach the debit spreads, you might look at that different. But you did say selling spreads, so we're just going to focus on the credit spreads. I want you to notice here very quickly that some of the criteria that are listed, we are looking for stocks. I always want to avoid earnings between now and expiration. I'd want a stock to be trading above a 20-day moving average, and I want a positive MACD by at least 3 days for the bull put spreads. Why is that important? Well, because whatever criteria you use, if you decide to focus on probability, you increase your probability to, say, a 90% over the 85% that I'm using in the defaults here. Or you want to go by delta and putting in a delta of, say, 0.15 for the sell option delta, less than 0.15 for the sell option delta, or less than 0.2. And I'm looking for stocks trading above the SMA 20 and, of course, the MACD line. Why am I mentioning all of this? I'm mentioning this because the criteria that you use to get into a position, technical, even if you're using fundamental, but more likely the technical criteria you use to get in any position are the same criteria that you would use for getting in and out, in my opinion. These are my trigger points. If the stock drops below the SMA 20 and it drops below the MACD, that's 2 out of 4 really, of the trigger points that I might use. Now, if you use stochastics, if you use Bollinger Bands, well, if the Bollinger Band change or the stochastic change does not equal what you'd want it to get into the spread position, that's going to be the time you want to consider rolling or adjusting the position. Those are going to be the trigger points. Okay? So whatever you use to get in, that's going to be the trigger points as well. Now, if you use delta, or I'm using probability of 85%, and you're using a delta of, say, 0.15, if the delta, say, goes to 0.3, or my probability drops to 70 or 65%, that might also be another trigger that I would use. A common one I also use is the 1% rule. On this position, our stock's at about 170. It's at 169.15, and we're selling the 155 put. Okay? So in this case, if the stock fell to within 1% of my short put strike price, or about 156.50, I might now consider time to adjust the position or roll the position. And that, of course, Dan, follows along with the 8 ways and the ways to manage a bull put credit spread. That's the next step. And we would discuss that. There's a full webinar on the 8 ways to manage a bull put spread, which also applies to bear call spread. Just have to reverse it. Okay? So, excuse me, in the search, there are default searches there. We talked about, oh, I'm sorry, I should just go back here. You have the weekly bull puts, but there's also monthly ones out there. You can adjust the criteria based on your needs. I don't just pick from the top 3 when I'm doing it, as I do with any strategy. We'll cover this for Octavio in a second. what I'm going to then do is my research and analysis. I'm going to take a look at the stock chart, make sure it matches my goals and the direction that I want for this strategy. If I don't know the position, I'm going to take a look at the news, the profile, maybe some balance sheet information. I might do, of course, further research, just look at the put research. But again, if I wanted to see implied volatility or if I wanted to see ratios of implied volatility, I would just use the add remove columns feature here on the screen to add those in to have them in my analysis on the search tool. Anything I can filter by down below, I can have available for me in the columns in any search. And all the searches sort of look the same. Okay. And then, of course, I may go to the profit and loss chart, or I may go to the midpoint spread chain to see other spreads around this one to see if I can get maybe a 20 or 25, I'd say 20% return with a 90% probability on this stock. That would be kind of interesting. That might be a good trade-off, giving up 5% for a 5% higher probability. But that's what I could access on the spread chain tool. And then I'd go to the profit and loss chart as we just did. I might run my what-if scenarios and more. Okay, so that is a brief review of what to use for the criteria. I prefer to use the 2 weeks out. After advanced testing that I did and trading myself, I found that the 2 week out spreads outperformed over time trying to force 1 week out as well. So that's why we're looking at 2 weeks out instead of weekly. And the 2 week out, of course, performed better than the monthly on an annualized cost basis and an annualized return. Now, at any time, of course, you can go to the free webinars page, and we'll go to option strategies. Octavia, there's one for you, managing naked puts. That's not what you're asking about, but there's one for there. There's a variety of different ones here. But further down, as you scroll further down, there's some here on credit spreads beyond the basics. It takes a look at expectations, structure, criteria, trading plans, and position sizing with focus on using the PowerOptions tools. Here's that 8 ways to manage a bull put credit spread. And this one here, how to be successful with spread trades, also discusses the expectations, structure, criteria, and historical results for bull and bear spreads, and of course, using PowerOptions to implement that. That's more in depth than what we just covered here. But as far as the criteria to use, the reason why we have these default criteria is this is where Ernie and I would start. And I would start with the bull put weeklies. Again, once I make that change that I forgot to do today. There we go. And then, of course, in addition to that, the weeklies on the bear calls. But if you wanted to go monthly, you'd look at some of the other lists there as well. All right, give me 1 second here. I'm scrolling down through the long list. I am going to do this real quick, okay? Sam says, credit spreads are good, but it is limited income. Absolutely, Sam. It's a known risk and a known loss, but it is an 8-to-1 risk-reward ratio. And in that case, that's why I always recommend you don't trade more than 10 or 15% of your total portfolio with this structure as well. Oh, and that's what you said. Your account is 40 stocks, 30 cash, 15 spreads, and 10 speculative trades. Excellent, Sam. Excellent. Richard, I got to this one. What is your time frame for bull put spreads? And there's your answer. I look for the 2 week out, so I'll open on Monday, what has 11 days left to expiration, and I found that has outperformed the week by week positions as well. Okay, and that's discussed in those webinars. Those webinars are just pointed to you on the webinars page. It discusses some of the comparison between using 1 week out spreads in the outturn and this as well, looking further out. Okay, all right. Okay, let's see. Give me 1 second, ladies and gentlemen. Okay, let's go back to that position. This is a different topic, and I know there's another question. Octavio, you're next, but I'm going to try to scroll through this to answer questions that weren't related to what was just asked in relation to this, but are related to credit spreads. Let me clean this up a bit. Let's just do a 50-cent spread. Okay, on a 2.5 points. Oh, and Richard, another thing there. My time frame is 2 weeks out, and I prefer to go at least 2 strikes apart or more, 2 points apart or more. And I'll explain why on this question. Now, you had asked, in credit spreads, if the price drops into the money with 2 weeks to go, where should I set the stop if I'm willing just to break even? Well, keep in mind that the break even is a moving target on the credit spreads, of course. The total break even is here. Okay, so the total break even naturally on this position we're shown here is at 154.50, so just got 50 cents there. But considering time value is still going to be there, the break even at the halfway point might be here, not below the current stock price. Okay, so as a general rule, following this back up with Richard, I use the 1% rule. That's my preferred opinion there, is that I want to use that 1% rule as one of my stops. So if the stock reaches within 1%, I don't want the stock to go in the money. Okay, I don't want the stock to drop below my short put strike price and my bull put credit spread, or above my short call strike price. So that's why I use that 1% rule in that case, Richard. Okay, so if that is the key, as the stock falls here, I'm going to look to manage it in potentially one of those 8 ways in the webinar that's there on the webinars page. One of the reasons why I like to leave 2 strikes apart, and this isn't 2 strikes apart, it's 2 points, but if I was in a 154 and a 152 strike, if the stock reaches this point, I only have a few days to go, and I think it might recover, I may just roll the short leg down one. Instead of trying to roll the whole spread further out in time, which is not one of my favorite management techniques on it as well, I may just roll the short down to the 153. So now I have a 1-point spread with only 2 or 3 days to go. Now, if the stock falls between the strike prices, you're probably at a loss, even with 2 weeks to go. You're probably looking at a range, if it's right between the 2 strike prices, you're probably looking at a loss of 40 to 60%, somewhere in that range of the maximum expected loss. So it might be around 90 cents, $1, $1.10 loss to close this position. That's why I don't want to let it get too far away from me. If it's within 1%, this might only be a 20% loss of the max expected, 40 cents or so, and I could probably make that back up with a new trade. Not necessarily rolling it down, not just staying in the same trade. If the trade starts to go against you, rather than trying to adjust it, even though we teach 8 ways to adjust it, you might just want to close the spread for the loss, Richard, go back and search using the criteria for new positions that match your needs, and try to make up the loss you took over time with other spreads that are going the direction that you want. That's an idea as well. Okay, so I want to stop it before it gets in the money. Now, a lot of investors say, well, if you made 50 cents credit on your position initially, why not just set a stop at 2 times or 3 times the credit? So if your debit gets to $1 or your debit gets to 150, why not close it? Okay, well, that's about the same as the 50%, isn't it? But I don't like to use the premium or the debit to close price as a stop. Why? Because if for whatever reason some news comes out over the weekend, let's say I enter this position today, news comes out over the weekend and the VIX and UVXY and the volatility across the market spikes another 10 or 12% as we saw the other day, and then it pulled back, but let's say it goes up 10% from where it is now, and there's fear, but the stock didn't move. This stock stayed right around 169 or 168. But if the implied volatility increases, the cost now to close this spread might jump to $1, that target, or 250, even though it's still 14 points out of the money. Okay, so you can get tricked on that, trying to use the price or the liquidation price, 2 times the net credit received, to try to control losses with fluxes in volatility. And right now we're seeing a lot of fluxes in implied volatility, so I don't use that as a stop. I like to use the stock price itself as 1%. Now, of course, we know that something could go wrong and this could gap down on Monday and be trading at that 153, 154 mark where it's now between my strike prices. Well, one of the 8 income methods talks about what to do, and I call it the pendulum adjustment, where I'll actually just move the long call in that case if the stock does end up between my 2 strike prices, leave the short where it is, and now I've turned a bull put credit into a bear put debit as the stock is falling that won't have as much profit, but may still be a profitable position in that case. Okay, so that's, Richard, that's what we're looking at there. Oh, and then Dan follows up that. Another problem with setting the stop with the spread is when the stock gaps up after hours or sometimes at the late of the day. Yeah, those movements which cause extra volatility or extra swing movements at the end of the day or in the aftermarket hours, that can cause a problem for the spreads on the position where they hit the price very fast, even though the stock the stock is moving, but they hit the price due to a volatility flux as well. Okay, so another question coming in was semi-related to this, and it's not really a question. Okay, I'm sorry, is that a question? It is a question. There it is. Keith said, is there a way to see what the standard deviation is on the spread risk, on a spread in the risk graph? No, I don't have the, Keith, I don't have the spread deviation there. We don't have extra filters right now to show that on the table, and I don't have it to be able to see the probability either. But in a sense, the probability, of course, is related to the standard deviation in the sense that the, what is it? Now I forgot the numbers, of course. Again, I want to say that the 80% volatility, 80% probability is usually around 2 standard deviations, I believe. 68% is 1 standard deviation, if I'm not mistaken. 68% probability is 1 standard deviation. 80% probability is 2, I think. 3 standard deviations is 92? 88 or 92, I can't remember off the top of my head how on average that works out. So when I know that I'm looking for a minimum 85% probability, I know, Keith, that I'm already in a 2 standard deviation value away from the current stock price. That's usually how it works out mathematically from what we've seen historically. Okay.